Probal Sen is here, not to discuss whether he caught Oppenheimer or Barbie, but to discuss Reliance. And Probal, while retail and Jio seem to be firing all cylinders, it's the oil and gas business which was a bit of disappointment, I guess. What was your read-through of the numbers?
Yeah, I think the OTC segment obviously has been a little bit muted. I think the advantage of Russian crude and the lack of windfall taxes notwithstanding, what it does look like is that GRMs did probably drop by maybe $3 to $4. Let me clarify that Reliance does not disclose its GRM numbers. These are our estimates based on the product slate that we have, and our estimates of product spreads. That GRMs overall should have actually dropped by about $3 to $4 sequentially for Reliance. And even in the petrochemical segment, what they did mention is that the margins were little bit of a mixed bag, with some QOQ improvement seen in PE and PP spreads, but for PVC the spreads were particularly weak. I think the important thing really is that if you look forward to the next couple of quarters, the extent of Chinese demand recovery continues to be a key monitorable. I think the management did mention that they are seeing decent demand strength, particularly in the domestic market for petrochemicals. But for the refining market, it's overall Chinese demand which will be a key monitorable. Till that actually comes through, one suspects that even for Q2, the OTC segment earnings might remain a little bit muted. You did mention Geo and retail, at least on a YoY level, continue to grow strongly. That momentum will be there. And then the one bright spot that I would look at it is that on the upstream front, gas production continues to actually meet the guidance. They have signed up sales contracts for at least 28 to 29 MMSCMD. So that segment continues to actually deliver the kind of revival that had been promised a couple of years ago. And the fact that net debt also has been flattish on a quarter-on-quarter level, that's another thing that is a little bit of a positive. But from a earnings perspective, I think we are set probably for another couple of quarters of weakness before you can see a meaningful recovery happening in operating earnings.
Also, Prabal, do you think that for the energy business, the worst could be behind? Because there has been a sharp pullback in the GRM. So, one would deduce that in the quarters to come, this would mark an improvement.
Honestly, if you look at the Q2 levels, while GRMs have pulled up, the petrochemical business remains, a little bit muted. I think there is still a long way to go for petrochemical margins, particularly on a YY level. If you really look at it, key petrochemical deltas are still way, way below what they were in FY23 and well below 5-year average levels. So you're right that there has been some recovery in GRMs in light of the fact that the new production levels of OPEC plus countries, specifically Saudi Arabia, started to kick in from the beginning of July. And that has prompted a little bit of recovery in both crude prices as well as product spreads. But that won't on its own be enough for the OTC segment to really start, firing. If you look at the annualized run rate of EBITDA that I think our estimates and maybe the street estimates also suggest, that would be anywhere from 65 to 70,000 crores. Whereas on the basis of the run rate for Q1, they are looking at somewhere around 60,000 crores. So that's what I mentioned, that H2 actually needs to really come through for RIL to sort of meet street estimates on earnings, both for OTC as well as overall consolidated numbers that I think we are all building in at this point of time.
So what's the call on the stock looking at the numbers, Probal, now that, the adjustment of Jio Financial Services is out of the way?
Well, frankly, the adjustment basically does nothing for RIL per se, other than basically adjusting the share count upwards. Because now, when we were used to look at diluted earnings, we used to exclude the 410 odd million treasury shares, which now gets added back because now there's a external shareholder of those shares. Other than that, we've not really changed our earnings much. We've had an ad rating on RIL with a 5 to 6% upside for some time now. That remains. Our basic contention is very simple. We do see peer leading earnings growth continuing to be there for the company for the next couple of years. We think that RIL will probably lead the large caps in terms of pace of earnings growth at about 18 to 20%. And the earnings potential of new segments is also not in doubt. The only thing that sort of curbs our enthusiasm a bit is that CapEx continues to run ahead of what we had thought. And therefore, the FCF yield for the company, that's free cash flow yield, probably will remain in the sub 2-3% levels. And because of that, the return ratios for the companies will probably remain at sub 10% levels. So combine that with the fact that the stock is already trading at somewhere around 18 times on a 1 year forward level of 140 rupees a share, which is what we are building in. And we think that the upside gets capped at between 5 to 7% from here on in, which is why we have sort of a cautious ad rating on the stock as of now.
Sure. Prabal, great to have you on the show this morning. Thank you so much for taking the time out.
Thanks for having me.